What do you get when a former SoftBank president walks into a firewall company and says, "We're going to be the platform"? You get Palo Alto Networks, a $123 billion cybersecurity empire that just posted its best operating margins ever. And the CEO just put $10 million of his own money on the line.
That's Nikesh Arora, and that personal stock purchase in March was his first major open market buy in years. When the person running the company is writing 8-figure checks at these levels, it tells you something about where they think this business is headed.
Welcome to episode 125 of Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're breaking down every number, every catalyst, and every risk behind the biggest name in cybersecurity. Let's get into it. So Palo Alto Networks was founded back in 2005 by Nir Zook, a former engineer from Check Point and NetScreen. The original idea was straightforward: build a better firewall. And they did. But what the company has become today is so much bigger than that.
Today, PANW operates across 3 core pillars. You've got network security, that's the next-gen firewalls they're known for. Then Prisma, which handles cloud security and SaaS. And then Cortex, which is the AI-driven security operations platform anchored by XIAM. Together, those 3 pillars serve over 85,000 customers globally.
And the headquarters is still in Santa Clara, California, with about 16,000 employees. But the real story here is what happened after Nikesh Arora took over in 2018. He inherited a $19 billion company selling individual security products. His vision was to turn all of that into one unified platform, and that's exactly what he's doing.
It's called platformization, and the numbers show it's working. They now have 1,550 platform customers, up 35% year over year, with a net retention rate of 119%. That means existing customers aren't just staying, they're buying more every single year.
And here's the thing that blows my mind. The moat isn't just the products. It's the data. PANW processes 15 petabytes of telemetry every single day across that customer base. That's the kind of data advantage that gets harder and harder for competitors to replicate.
Exactly. And they claim that data allows them to detect and stop threats 180 times faster than competitors. Whether you believe the exact multiple or not, the scale of their data pipeline is genuinely unique in the industry.
Let's talk about the man behind the transformation. Nikesh Arora joined Palo Alto Networks as CEO and chairman in June 2018. Before that, he was president and COO of SoftBank Group, where he earned over $200 million in compensation, a record in Japan at the time. And before SoftBank, he spent a full decade at Google as SVP and Chief Business Officer.
On Wall Street, Arora gets credit for being a visionary dealmaker. Under his watch, PANW's market cap grew from $19 billion to about $123 billion. That's over $100 billion in shareholder value created. Jim Cramer has called it one of the most impressive CEO tenures in tech.
And the acquisition spree tells you everything about his strategy. Over the last 2 years, he spent more than $30 billion on deals: CyberArk for $25 billion, Chronosphere for $3.35 billion, Protect AI for $700 million, and IBM's QRadar SaaS assets for $1.14 billion. Each one fills a gap in the platform vision.
The risk with that approach is integration. $30 billion in acquisitions is a lot to digest. But so far, the execution has been clean. XIAM customers are growing, platform deals are accelerating, and margins are expanding. Arora has earned credibility, but the next 12 months will tell us if these bets truly pay off.
All right, Lana, this is your domain. Take us through the financials.
Let's start with the top line. Trailing 12-month revenue is $9.89 billion, growing at about 15% year over year. The most recent quarter, Q2 fiscal 2026, came in at $2.594 billion, a beat but not a blowout. Revenue growth has been consistent in that 14 to 16% range for several quarters.
And what about the earnings picture?
Non-GAAP EPS for the latest quarter was $1.03, beating the 93-cent estimate by a dime. Over the trailing 4 quarters, they've beaten on both EPS and revenue every single time. But here's the caveat. Q3 guidance called for EPS of 78 to 80 cents. well below the 92-cent consensus. That's what sent the stock down 7% after the report.
So they beat on the quarter but guided light on earnings. What's behind that?
It's the investment cycle. Platformization requires upfront spending, integration costs, go-to-market expansion, and onboarding new platform customers. Revenue guidance for Q3 was actually strong at $2.94 to $2.95 billion. So the business is growing. The margin pressure is a choice, not a structural problem.
What do the margins look like right now?
Gross margin is 73.5%, solid for a company with a hardware legacy. Non-GAAP operating margin hit a record 30.3% in Q2, and the free cash flow story is outstanding, $3.57 billion in trailing free cash flow with a guided FCF margin of 38 to 39%. That's elite cash generation.
And the balance sheet?
$4.5 billion in cash against just $383 million in debt. The debt-to-equity ratio is essentially negligible at 0.05. Current ratio is 1.04, tight but manageable. They've dramatically deleveraged over the past 5 years. Overall, Palo Alto Networks' financial health is strong, profitability is expanding, cash generation is elite, and the balance sheet gives them enormous flexibility for continued M&A.
So what's the analyst community saying about all this?
84% of analysts rate PANW a buy or strong buy, with the remaining split between hold and a small handful of sells. The consensus 12-month price target sits around $210, which implies about 31% upside from the current price of roughly $160. The range is wide, though. The low target is $114, the high is $265.
That's a pretty wide spread. What's driving the divergence?
Bulls point to the accelerating platform adoption, the ARR trajectory, and the FCF machine. Bears worry about the premium valuation at 88 times trailing earnings and the EPS guidance miss. Citigroup updated coverage in February, maintaining a bullish stance, and management raised their long-term ARR target from $15 billion to $20 billion by fiscal 2030. That's ambitious, but so far the trajectory supports it.
In the last earnings report, it was a beat on the numbers, but the market didn't love it.
Right? Q2 beat on revenue and EPS, but the Q3 EPS guidance at 78 to 80 cents versus a 92-cent consensus spooked investors. The stock dropped 7%. That said, next-generation security ARR hit $6.33 billion, growing 33%, actually accelerating from prior quarters. The market focused on short-term margins, but the leading indicators are strong.
Let me lay out the bull case first. The platformization thesis is working. 1,550 customers and growing 35% a year with 119% net retention. XIM has 470 customers, spending over $1 million each in ARR, and the data mode of 15 petabytes per day creates a compounding advantage that pure-play competitors can't match. Add in the FedRAMP high authorization across all 3 platforms, opening up government budgets, and the CEO putting $10 million of his own dollars down, and you've got a business that's executing on every front.
The bear case starts with valuation. At 88 times trailing earnings, PANW is the most expensive stock among its cybersecurity peers, and it has the slowest revenue growth. CrowdStrike is growing at 22%, Zscaler at 24%, PANW is at 15%. You're paying a premium for a business that's growing more slowly than the competition. Then there's the $30 billion acquisition binge. CyberArk, Chronosphere, Protect AI, QRadar. That's a massive integration burden. And the EPS guidance miss tells you margins are under pressure in the near term. Finally, 43% of enterprises still say they plan to expand their vendor count rather than consolidate. If the platform thesis doesn't resonate with buyers, the premium unwinds fast.
So it's execution versus valuation. The business is doing the right things, but the stock needs to grow into the price.
That's exactly how I'd frame it. The next 2 quarters will be critical.
Let's see how PANW stacks up against the other big names in cybersecurity.
I'll run through 3 key peers. CrowdStrike trades at about $397 with a $102 billion market cap. Their forward PE is 83, price to sales is 28 times, and their growing revenue at 22%. But here's the catch. CrowdStrike is still GAAP unprofitable with a negative 5% operating margin. They're the growth leader, but profitability hasn't arrived yet.
What about Fortinet?
Fortinet is the value play. $77 stock, $57 billion market cap, and a PE of just 32 times, less than half of PANW's. They've got the best gross margin in the group at 80% and a 31% operating margin. Revenue growth is 14%, so they're not running away on growth, but the valuation gives you a lot more margin of safety.
And Zscaler?
Zscaler is the smallest at $20 billion market cap, trading around $122. Forward PE is 25 times, the cheapest in the group. PS is just 6 times, and they're the fastest grower at 24% revenue growth. Gross margin is 77% with a 22% operating margin. If you're looking for growth at a reasonable price in cybersecurity, Zscaler is hard to ignore.
So PANW is the profitability king, but competitors offer either faster growth or cheaper valuations. That's the trade-off. What's the options market telling us?
The put-call ratio sits at 1.06, just slightly above 1, which leans marginally bearish. Implied volatility is at 43%, elevated about 3 to 4 points above the recent baseline, suggesting traders expect meaningful price swings. Open interest is clustered heavily in the 170 to 200 strike range on the call side, and there's significant put interest around 150 and 140. Among whale trades tracked recently, the split is roughly 45% bullish to 22% bearish, with the rest neutral.
So the options market isn't panicking, but it's not exactly throwing a party either.
It's cautious positioning. The elevated IV tells you traders see volatility ahead, probably around the May 26th earnings date. The heavy call clustering above 170 suggests some traders see upside, but the put protection at 150 tells you the floor isn't firm. As always, options flow is one data point, not a forecast.
What about insider activity?
Over the last 6 months, there have been 39 insider sells and just 1 buy. But context matters enormously here. The vast majority of those sells, including CFO Deepak Galecha's 5,000 share sale and Director John Key's 1,500 share sale, were executed under prearranged Rule 10b-5-1 plans. Those are set up months in advance and don't reflect real-time sentiment.
And the buy?
The buy is the headline. CEO Nikesh Arora purchased $10 million in stock on the open market in late March. That was his first major open market buy in years. When a CEO with Aurora's compensation and wealth makes that kind of voluntary purchase, it's a strong conviction signal. The scheduled sells are noise. The CEO buy is the story.
What should investors be watching going forward?
5 things. First, watch the revenue growth rate relative to peers. At 15%, PANW is trailing CrowdStrike and Zscaler. If it slips further, the valuation premium will compress. Second, integration execution on the $30 billion acquisition haul. CyberArk alone is a $25 billion deal. Third, the EPS trajectory. The Q3 guidance miss was a warning that margins could be volatile as they invest in platformization. Fourth, platform customer adds. They need to keep growing that 1,550 number by at least 30% annually to hit the $20 billion ARR target. And fifth, the competitive landscape. Microsoft's bundling strategy is the underappreciated risk nobody talks enough about.
The May 26th earnings date is going to be huge.
It will be the single most important data point for the PANW thesis in the near term. Revenue execution, platform customer adds, and margin trajectory, all 3 need to deliver.
So let's bring it all together. Palo Alto Networks is a company doing something genuinely difficult, transforming from a firewall vendor into a full-stack cybersecurity platform, and doing it while expanding margins and generating $3.5 billion in free cash flow. Nikesh Arora has created over $100 billion in shareholder value, and he just put $10 million of his own money behind the bet.
The key metric to watch is next-generation security, ARR. At $6.33 billion and growing 33%, it's the single best indicator of whether platformization is actually translating into revenue. If that number accelerates past $7 billion by Q4, the bull thesis is firmly intact. If it decelerates, the 88 times PE becomes very hard to defend. The business is strong, but the stock needs to earn its premium every quarter.
I want to close with this quote. The organizations that will succeed will not be those that deploy the most advanced AI. They will be the ones that know how to leverage it operationally. And I think that captures the PANW thesis perfectly. It's not just about having AI in your security stack. It's about turning that AI into results that customers can measure.
And with XIM processing 15 petabytes a day and reducing response times from weeks to minutes, they're walking the walk on that promise. Whether the stock can keep up with the business is the open question.
That's going to do it for episode 125 of Charged Alpha, our deep dive into Palo Alto Networks. If you found this helpful, make sure you're subscribed wherever you're listening so you don't miss the next one. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.